to another fast track webinar. I couldn't be more thrilled for today's session. Before we get started, once again, I am Peter Benjamin. I am the president at ACUMA. Just again, before we get started, a few housekeeping items. This webinar will be recorded and posted to our website in the coming days. I will be monitoring the Q&A in the chat, so feel free to ask questions and I will do my best to weave them in. Now, finally, registration for this year's Make Your Mark annual conference is open, so don't forget to register. Now, here's a QR code. So, if you can, I would urge you to take a picture of this QR code or scan this QR code. This is shaping up to be the event of the year that you're not going to want to miss. It's going to be the best annual conference that we've ever put on. So, to that point, today's special guest is one of the keynote speakers. If you like today's webinar, you're not going to want to miss what he has to say in September. Okay. Now, before we get started, just a quick disclaimer. The views and opinions expressed during today's webinar do not necessarily reflect the views or positions of ACUMA, its board of directors, its management staff, or its members. The webinar and its materials presented as a set of ideas and possible strategic strategies regarding specific topics. They do not represent any endorsements of the presenters, their firms, or the concepts they represent. So, let's carry on. Today's webinar is being brought to you by Take 3 Tech. Joining us today is Mike Turner, Director of Sales. Mike, why don't you come on stage? Welcome. It is great seeing you. It's been a while. How are you doing?
I'm
And
doing
by the way,
well.
congratulations on the new position.
Oh, it's great. It's really nice over here.
Well, so it's now I've had the pleasure of getting to know you over the years, and I couldn't be more thrilled to see you over at Take 3 Tech. And I was excited to see your name pop up as, the sponsor representative. And I'm excited to have this, quick little conversation with you because I want to pick your brain. And so I'm going to hand you a crystal ball for a quick moment. I'm going to put you on, the hot seat. So with our expert speaker, our special guest today, he's going to give us a quick layout of the economic or the housing economic lay of the land. What's your take? Are rates going up or are they going down?
Well, I have to admit, our crystal ball is a little foggy. Like everyone here, we're here to hear what our speaker has to say about where the economy is headed. That said, one thing we can predict in confidence is that loan maps helps lenders thrive. Whether rates go up, down, or stay steady at Take 3, we can take 3 of your platforms, consolidate them down to one. We have 2 main products that are integrated with each other. We have Loan Maps, which is a convergent LOS, POS, and CRM all connected in one master database. And then we have the Rule Tool, which is an agency guideline search engine. It aims at to consolidate and simplify all the guidelines and overlays into one place so you can access them in seconds. There's an app for both, enabling the user to work anywhere, anytime. Going back to your question, if rates drop, for example, our built-in rate watch feature in Loan Maps lets lenders act fast. In just seconds, they can identify the borrowers in their CRM who'd benefit from lower rates, automatically generate a personalized email with loan-specific details, and then it sends an invite to re-engage through the point of sale. The borrower can schedule their next steps online. And thanks to Augie, our built-in AI assistant, clients get guided through exactly what's needed for approval, making the whole experience smooth and proactive. What do you think of that, Peter?
Sounds great. All right. So you talked about if they go down. Now, of course, what everyone's fearing is if rates go up. You know, here we are, 6.5, 7%, not the worst thing ever. But what if they go to 8? What if they go to 9 or even higher? What if rates go up? What happens?
Well, if the rates go up, I mean, there's the economic uncertainty. Looking at the economy and Colin Powell and what they're trying to do, I think we should let our speaker address that.
Okay, that's fair. So as affordability continues to be a concern, what can lenders or just credit unions do to better manage costs to produce? And I guess, kind of diving into how Take Three can help, what role do you see automation and technology playing in helping credit unions stay competitive in today's market?
Well, I think time is money, and to be able to have more time to have the automation AI walk you through exactly what needs to be done. With the rule tool, I mean, you can see exactly the agency guidelines, the investor guidelines, overlays. If you're working off at PPE, maybe you'd want to look at the best price lender and thinking that's great, but they don't have the right guidelines at the end of the day. So you have to go back and redo the whole thing over again. And that time, I mean, what does that time cost really?
Yeah, I agree. And I like that you said that time is money, especially with the rising cost to originate a mortgage. you know, your time becomes even more expensive on a daily basis, right? And so I think that is a very valuable point that automation can, if anything, make that cost go down and hopefully reduce the affordability of that mortgage for you, for our members, your borrower, right? So I like that. So, Mike, we have to carry forward. This is a very limited time that we have. Thank you again for sponsoring today's webinar. Truly
Yeah, I appreciate
appreciate.
your time.
No, of course. Now, truly appreciate you. It's good seeing you over at Take Three, and I'm sure we'll see you soon.
Okay, thank you, Peter.
Thank you. Now, it's my pleasure to welcome today's expert, a man who's more than likely known for having the best hair in the industry. He's HousingWire's lead analyst, Logan Mohtashami. Logan, welcome back to another one of our webinars. Excited to have you here.
It's wonderful to be here. It's just another crazy headline-driven year, so we have a lot to talk about.
Yes, yes, we do. I have a laundry list of things I need to talk to you about. So today, obviously, we're focusing on the housing market and an economic outlook. And Logan, I think we can agree that this is probably one of those conversations that could give many people heartburn, especially when we factor in all the uncertainty, the on again, off again tariffs that really seem to model a bad romance on Love Island. And then when we factor in a possible war in the Middle East, I mean, so let's talk. Like, I think we have a few things that we want to talk about. We're going to talk about potential recession, the Fed's next move, which Housing Wire this morning had an interesting headline about uh, tariffs and trade policy and emerging housing trends, and that we have a lot to squeeze in about, at this point in time, about 30, 35 minutes. So Logan, let's dive in. Starting things off with the recession risk. Simple question. What early signals should our audience monitor more closely to prepare for a possible recession?
So if everyone wants the cheat code for economic cycle work,
Who doesn't? Who doesn't? Up,
there
down, up,
is,
down, left, right, left, right. Everyone wants
yeah,
that.
there is one data line that has been exceptionally well going back many decades. I have my own recession models, but my labor triggers that force me to, use the R word is when residential construction workers start to lose their jobs. In every single economic cycle in recent history, you take COVID out of the equation. That is a labor trigger for a recession because typically what happens later on is jobless claims start to rise up to a certain number. And what's happened really since 2010, every single recession call has been incorrect outside of COVID, which was a shock because residential construction workers were never losing their jobs in any fashion. And then also jobless claims weren't rising to a certain level tied to the civilian labor force. So if you want to just follow one data line, that's the data line I would focus everyone. That's the data line I've been trying to get people to focus on for many years. And we're sitting here in 2025 in June, and still we haven't seen those labor triggers just yet. The labor market is softening. I will use Jerome Powell's own words. If you're looking for a job, it's tough, but the labor market isn't breaking yet. And I think breaking and softening are two different things, especially for my work. I've always said since 2022, the Fed isn't going to really pivot in a way that housing would want it to until the labor market starts to break. We're getting closer to that area. There's a lot of drama with the Federal Reserve and Jerome Powell, especially going out for the next 6 to 11 months. That is almost non-economic related. But for now, things, labor market softening, not breaking just yet.
Okay. So, I like you, I love charts. Granted, they don't call me chart daddy, but we've all seen, the Fed funds chart that shows, the timeline of how the Fed funds correlates with recessions. And what we see from this is that there are different types of recessions, mild and severe. So to that point, how might a mild versus severe recession differently impact the housing and mortgage markets?
So I would say this, one of the other charts I've been showing recently is how does the housing market react toward recession? It tends to be the most outperforming sector out of everyone. Why? Because if you look at the history of existing home sales, they typically start to fall as the Fed starts hiking rates to tighten up monetary policy. They find a low base, and then the recession comes, and all of a sudden, existing home sales start to rise, not only for a short period of time, but for many years. And that's how housing typically reacts. Now, it outperforms in a recession, but it also can underperform when the economy is doing well and the monetary policy is very tight. A great example is the last 3 years. The last 3 years, we are running at the lowest home sales ever recorded in history, time into the workforce, but the economy has been doing well. Now we're at a point to where existing home sales have bottomed. They've bottomed for some time. And the positive aspect is that active inventory has grown enough to where we could kind of lay away the low inventory discussion. So when mortgage rates fall, as they've done in every single economic cycle in that regard, then all of a sudden existing home sales have a better backdrop to grow more. The problem I've always had with housing in the last few years is that inventory broke to all-time lows when demand broke to pre-cycle highs early 2020. So the supply and demand equilibrium was terrible. Home prices were escalating out of control. Home prices escalating out of control does no one any good. It just kills future demand. But now price growth is slowing down. Inventory is growing. We found a base. Today, I always tell everyone, today, purchase application data came out, 21 straight weeks of year-over-year growth, 8 straight weeks of double-digit year-over-year growth. Nobody wants to talk about that because doom porn sells and that stuff, it's like nitty-gritty economic work. So the backdrop is better for housing now than I would say 2 years ago. But lower rates typically gets the housing market to outperform in the future. Obviously, when you're working from the lowest levels ever, it doesn't take much to move the needle. So I'm very encouraged about housing if the economy starts to slow down, whether it's a mild recession or severe recession. Housing tends to outperform because rates tend to fall, and that's what the sector needs to do its traditional outperforming in a time of stress.
So, I mean, you mentioned, the Fed and Jerome Powell a few times. You know, I said it earlier, but this morning, you guys published an article, and we heard that Jerome Powell isn't going to budge on interest rates and that they'll continue to play the, wait and see game. But that doesn't spell what's really going to happen in the next 12 months or what they plan to do in the next 12 months. So in your opinion, what are the likely scenarios for the Fed actions in that 12 months? And which scenario, I guess there could be multiple scenarios, what poses the most significant risks for lenders, credit unions, I mean, banks, I mean, you name it, or it could just be our housing ecosystem. What scenario could potentially put us at most risk?
So naturally, right now, mortgage rates got to 8% in 2023. That year, the mortgage spreads were really bad. Today, we're at what, 6.75, 6.80. Mortgage spreads have improved. So the worst case scenario would have to be something coming out of the woodworks. Because traditionally, what happens at this stage of the economic cycle, the Fed starts cutting rates. They paused, which Jerome Powell is getting a lot of grief for. But then still the direction is forward because the Fed funds rate is up here and the growth rate of inflation is down here. So Jerome Powell in 2022 changed the course of the Federal Reserve. Back then, he said, before I called somebody spiked the Fed's eggnog on Christmas, he said, we would like the Fed funds rate to mirror 3, 6, 12-month inflation data. That's like 2.5%. Today, Morgan Stanley came out and said they're cutting rates 7 times next year to get down to 2.5 to 2.75. Now, there's 2 ways to look at that. Morgan Stanley believes the economy is going to go into recession and the Fed's going to have to cut, or, and this is the crazy part, for myself, when President Trump became president and he hired Bill Pulte to be the head of the FHFA, Bill Pulte, I was the first person that he followed on Twitter. And then the president of the United States shared my article on the day that he went and met with the Federal Reserve and told Jerome Powell, cut rates, homie, come on. Going out for the next 6 to 11 months, what we could see is what a theory that I brought in is called the shadow Fed theory, where the market just doesn't care what Jerome Powell says anymore because he's done. Whoever Trump picks for the next Fed president, okay, if he starts telling the marketplace on TV and everything, we are changing direction when I get there, he or she. If that's the case, then the worst is kind of over in that regard. It would take some kind of event to have the economy either explode higher where inflation takes off or some kind of credit bust system. So I think the worst was over 18 months ago. But now you got to get to that next phase. So if the labor data gets softer, housing outperforms. If Jerome Powell gets his Fed replacement out there saying we're going to cut rates a little bit more, the 10-year yield can go a little bit lower. Remember, 65 to 75% of where mortgage rates in the 10-year yield can go is Fed policy. If they start sounding dovish, that's beneficial for anyone. The counter to that is that inflation takes off, but the economy still outperforms and rates can go back up to 7.25. 7.25 is my peak forecast for 2025 because the spreads are getting better. So we have a lot more dynamics for mortgage rates staying here and heading lower than going up. And, even a lot of the Fed presidents have been talking about, we have room to cut in the future without the labor market breaking. So every time they cut more, the Fed funds rate, it lowers the band of the 10-year yield. That means it's easier for mortgage rates to get down to 6% or even lower. A lot of people say, well, when the Fed cut rates, mortgage rates shot up. Well, mortgage rates fell 2% from the peak to the bottom before any rate cuts happened. So there's a lot of positive things going out in the future. Whether Powell is here, not here, shadow Fed president, or the labor market getting softer, because rates have been elevated for a very long time. And not only can the 10-year yield get better, mortgage spreads can get better. If mortgage spreads are back to normal today, mortgage rates are 6%. That changes the dynamic. If mortgage spreads get back to normal and the 10-year yield just goes down a little, 5.5%, everyone listening to this webinar, sales can grow. Everybody does more business. So it's a better backdrop for the future. Price growth is slowing down. Inventory is growing. This is a healthy housing market, not the savagely unhealthy housing market where prices escalate out of control, inflation gets out of control. We're in a much better, healthier backdrop.
So, random question. Let's paint a picture about this, shadow Fed president. the administration appoints the shadow Fed president, and he or she is out there saying, this is what we're going to do, this is the direction we're going to take, with the Fed. But let's say Jerome Powell, in the last few months that he's in play, decides to take an Alamo stance, puts up that very last fight, and becomes vocal about what he wants to do, and completely it's complete opposite of what the shadow Fed pres wants to do. What does that do to the market? Doesn't that throw us into turmoil?
I will tell you this. Bond traders are here to make money. There are no bond vigilantes out there because bond vigilantes would not be good bond traders. You always work off what forward guidance is, because if you mess up the trillions and trillions of dollars of bonds being traded a day because of your ideological takes, then you're out of a job. So if the shadow Fed president, in theory, let's assume it's Kevin Warsh, somebody's name was out there, and he's out there, don't listen to Powell. We're going to go forward. Bond traders, if you want to be behind us, that's fine, but the other bond traders won't. So every day and month that gets into the period in time where Powell gets to leave, the forward guidance starts to firm up a little bit more. So if there is a shadow Fed president, then in that context, I think Powell becomes less relevant. I already think Powell is becoming less relevant to the marketplace anyway. But going out in the future, if this happens, now, if the labor market gets softer, it doesn't really matter. Bond yields get ahead of the Federal Reserve, rates go by themselves, the Fed plays catch up. The Fed likes the catch up mode. I think Cleveland Fed president, Beth Hammack, she said to the New York Times, well, we're just going to wait to see what happens, and we'll play catch up if the labor market, gets weaker. Bond traders don't operate that way. Bond traders will get ahead. So if there is a shadow Fed president, if that person is going on TV, every day that gets closer to May 2026, Powell becomes less relevant. Okay, so I think whatever stand he wants to do, it's for his legacy, but there's way too much money, way too many powerful people with money to allow somebody who's going to get replaced to kind of hold things up at bay. You're already seeing a civil war within the Federal Reserve, where a few Fed presidents are already saying, hey, listen, I don't mind a July rate cut right now. Let's get on that. So that's going to be the future of this discussion, because we have conflict within the Fed. But if Powell wasn't leaving, then it doesn't matter. He had the ability to stay, but his days are numbered, which makes him a little bit less relevant going out in the future.
That was actually my next question. Would that scenario be different if he had 2 years left, in his term?
Absolutely. If he had 2 years left, then you have to go with what the Fed chairman says, but that isn't the case. And unfortunately, we're at this area where they're basically name calling every single day, and I don't see that as being effective. But we also have to realize this isn't just about the housing market here. The White House wants the Federal Reserve to cut rates because the interest payments on the deficit go lower as well. This is why you see Trump talking about, 2.5% rate cuts, less interest being paid. That means the deficit looks better on there. Now they're trying to get this budget passed, but I think Trump would have loved to have a 2.5% lower rates just to have a little bit more wiggle room with a 10-year plan on the budget. So there's a lot more things going here than just the housing market, but in real terms, Powell's days are numbered. You're already seeing a few Fed presidents, Waller and Bowman, who are both conservatives, who are also in the running, start to talk about July rate cuts. People are getting ready to lay their spots to take over the kingdom. And I already think there's somewhat of a Powell not being that valid, but going out, it's those people that actually could guide future Fed policy.
Okay. Before one more question before we move on to tariffs and trade, because I think that's an important conversation for us to kind of focus on as well. And it's really kind of more of a strategic conversation for our audience. how should, credit unions strategically respond to the potential shifts in monetary policy to protect their profitability? And profitability as of late, has been something that credit unions are concerned about. A lot of them are focused on depositories or deposits like CDs and money markets and increasing those high yield savings accounts for income. But let's focus on the mortgage side. How can they protect mortgage profitability in this uncertain time?
So when we think of tariffs, tariffs are taxes, and the tax in itself cannot be inflationary in the big scheme unless you have a series of stuff that is coming in with a higher cost to where the companies can't eat it. They have to pass it down. And then it raises the total value of the items being raised with prices to fall into the inflation data. Right now, the last inflation print that the Fed tracks, the PCE number, 2.1% year over year headline. So obviously it's not here. But the Federal Reserve said, we think inflation can go up to 3% by the end of the year. Okay, if they have it at 3%, they don't have to hike rates or anything because the Fed funds rate is already elevated. They can cut rates even 2 times and still have the Fed funds rate above the growth rate of inflation where they're targeting. So to me, it still looks like the backdrop, even with tariffs creating a little bit more inflation, is still there to get those 2 rate cuts in. I think the worst case of the tariffs were when Godzilla tariffs happened on that day, all hell broke loose in the market, right? The stock market wasn't ready for it. The bond market wasn't ready for it. Hedge funds weren't ready for it. And it just created this market chaos. We don't have that problem anymore. Everything's calm. I mean, we just bombed 3 nuclear facilities, and the mortgage market on Monday was like yawning, right? The market is starting to get ready to the next stage of the economic cycle. And unless something happens with shortages, right? Shortages would be a problem. We weren't sending in, nobody was sending ships to us. That is starting to go away. So better trade deals, more trade deals announced, better for the Fed, less likely that inflation really takes off created by shortages, be a one-time price adjustment, and then we kind of move forward. So don't think of rate hikes. Worst case scenario, they don't cut maybe twice. But again, if a shadow Fed president is there and they're already saying, hey, we're not doing this anymore, it's a different ball game. But I think the tariff question was the worst case scenario to me was that you got no deals and nobody's sending anything to us. And one of the reasons why we don't have inflation right now is I'm Logan Mohtashami. I sell Chart Daddy shirts. I get them all from China. Well, everyone heard that tariffs are coming. They bought a huge pile of Chart Daddy shirts. Well, I have a ton of inventory right now, but now the tariffs are starting to go in place. I don't have to raise any prices because I don't have anything coming over. But over time, that can be an issue maybe for the second half of the year. But they're going to start sending stuff. I think that's the worst case scenario is if nothing was being sent over. So don't think of tariffs as like this breakaway inflation. When we had small tariffs in 2018 and 19, actually the growth rate of inflation fall. And then of course, if there's resistance by consumers on paying that, then demand gets hit. That in itself is disinflationary, not inflationary. So it is a very confusing topic place because people were expecting inflation to come down, but inflation expectations are falling down because the worst case scenario of Godzilla tariffs and no deals and everything is starting to go away. Why? Because the bond market went against the White House. You can't mess with the bond market. You had a reversal in yields. It shot up. People were talking about a recession. They got away from that. So look for deals to be announced, and anything that creates more supply being sent over, even if it's at a higher cost, is still better than what it was a few months ago where everyone was taking the worst case scenario.
Okay. Yeah. So you mentioned, on Monday when, obviously when we bombed the nuclear facilities, yeah, and obviously, things have progressed since then, but historically speaking, whenever we do enter into a war we'll say, enter into a war, interest rates have dropped and the housing market has improved. But you're kind of implying that nothing even happened, and that, in many ways, that almost signaled that as though we were entering into a war, but nothing happened on Monday. Is that correct?
To me, oil and bond traders have wised up on how geopolitics trade. And I even wrote an article Sunday morning saying, hey guys, nothing's going to happen, even before the market was even open. The bond market is acting a lot more calm these days. The spreads are the reason the spreads getting better is good is whenever the 10-year yield goes up, the spreads improve, it limits the damage. But as you can see, traders have kind of wised up to geopolitics. If there was a thought there was escalation, then it gets different, but nobody thinks there's going to be escalation anymore. They're even coordinating missile attacks on bases and telling everyone, hey, as soon as that headline went off, oil fell 15%. The bond market actually reacted to Michelle Bowman's "I want a July rate cut" discussion than what happened over the Middle East. So things have changed, not just for this year, but even in 2024 when we had another Middle East incident. We're not getting the traditional response of flight to the 10-year yield and going to the dollar and oil prices escalating. Everything is so quick that within 10 hours, the whole thing was over. It's just that could have been a very short-term event. But if you have no escalation, the story's kind of done with already. And that's why it got cleaned up very fast. You didn't see the normal reaction, money going to the dollar or money going to the bond market. So, which traditionally has been the case in the past. The stock market was up for the day. So a lot of things have changed throughout time, but having more global information out there, traders are a little bit more wised up to how to trade around geopolitical events.
Okay. Another question, and so kind of sticking with tariffs and trade policies, but I want to pull the shadow Fed pres into the conversation. If that person does become in play, does the administration's tariff and trade policy completely pivot?
No, I think this is just my observation. I think what the White House wants to do is eventually just get 10% tariffs on everyone, but 30% on China. And they can't play bully ball, how I call it. Godzilla tariffs were bully ball, just basically bullying people to a deal. And that didn't work out. So the markets went against them. They realized you can't operate with the stock market in a bear market and bond yields going up. So I don't believe in the concept of tariffs in itself, because if you really believed in tariffs, you wouldn't be making deals. You just put the tariffs there and then that's it. You change policy. So the fact that they're talking about deals means that they kind of want to limit the tariff percentages on a lot of countries, but really focus on China. And if you could get deals to move forward, and it's not that big of an issue. And I think that's where they're going, regardless of the shadow Fed president or not. Again, if they really truly believe they wanted to change the entire world order, they would simply put tariffs on and say, no negotiation. Everyone's going to have to change. They're not. They're already talking to deals with everyone. So the worst case scenario of the tariffs, I think people could put aside. And regardless of who the shadow Fed president is, you can't have the markets react as bad as they did when they first announced Godzilla tariffs. The shadow Fed president can't do anything about that. The markets will just roll right over you. So it is a good thing as long as you're talking about deals and making progress. That's a positive for everyone out there.
Okay. I mean, as you said, the administration wants 10% tariffs except for China. And we all saw, the big chart of tariffs for the country, for every single country. In your opinion, which tariff or trade policy development impacted our housing market the most profoundly?
I would say this: Godzilla tariffs, when it was announced, was just complete chaos. And it was so chaotic that the stock market went into bear market very fast. The 10-year yield went down to under 4%. So yields going down doesn't matter if it's a recession, benefit for housing, right? Because we have over 162 million people working. However, I didn't even agree with that move down there. I said, Well, listen, the labor market isn't breaking. So if we didn't have Godzilla tariffs, bond yields should be much higher. Once they started doing deals and talking about it, that stress kind of went away. So if the economy weakens because of tariffs, there's that discussion that goes on, benefit for housing. If you get more trade deals and the Fed, even today, Jerome Powell said, if we see deals being done, we have room to cut. Yesterday, he said, if there was no tariffs, we'd be cutting now. I don't agree with him on that statement, but you can see that they're trying to push people, get some deals in. We could start moving to get lower. We want to kind of get ahead of this before the labor market breaks, because once the labor market breaks, then they have to act differently. So there's a lot more positive outlook in the future because of that. And maybe Godzilla tariffs had to happen to wake up the White House that you just can't do this in a very fast fashion. But if there's no deals being talked and there's shortages again and nobody's sending ships, that's a negative for everyone. But for now, it looks like everyone's heading toward a direction that's a little bit more positive, a little bit more have a little bit more conviction on what the end game is.
So, I mean, you talk obviously you talk about a lot about the Godzilla tariffs and the on again, off again tariffs, and obviously, if Godzilla tariffs were here to stay, this would be a completely different conversation, right? There'd be
It wouldn't work. It wouldn't work. The
like,
stock market was 100% correct to go in a bear market. We would have a recession. And the thing with tariffs, and this is the honest truth, why doesn't tariffs work in America? Because of 2-year political cycles. And because Congress has the ability to remove the tariff power from the president, if they kept Godzilla tariffs on, Republicans and Democrats would have taken it away from him. And then after that, you lose the midterms, and then the last 2 years of your presidency, you're boggled down. So in a sense, this is a different strategy than what Trump did the first time. The first time Trump waited until he got his tax cuts, waited until before the midterms, and then went to the trade war tap dance with China. That was a very small trade war compared to what's trying to be done here. This was much different. This was, let's get into the fight and then deal with the aftermath. The aftermath told them you can't do Godzilla tariffs. You got to make some deals. So, and that's because Congress can take them away. So every day we get closer to midterms, they had to find a way. And look, stock market hit an all-time high again. Bond yields are down, markets are up. It's a much better place than what that was. Godzilla tariffs just created too much chaos out there.
okay. Now, last question on this topic. There's still a lot of concerns, and in many ways, we're still seeing it. Not everywhere, but we're still seeing it. There's still rising costs. And credit unions are fearing and concerned about the pressures related to tariffs and trade policies. So, in your opinion, how can they effectively manage that? And when I think about, conversations I have with a lot of our members, they're fighting every single day to keep their mortgage shop, their mortgage operations afloat, to keep their executives investing in their operations. So, in your opinion, how can they continue to manage, these rising costs related to tariffs or trade?
So tariffs would be more of a consumer-based cost on goods that are coming, so obviously Mexico and Canada are big trade partners, so are Japan. China is a lot of cheap service goods out there. So inflation is always rising. We're not a deflationary economy. What you can say going out in the future, I thought where Rocket Mortgage was buying everyone they could, is that the bottom is kind of in on the cycle. So it's how to capture what traditionally happens at this stage is that the next move is lower in rates, whether it's because the job loss recession, where it means you could go lower for longer, or it's just the Fed realizing they have to get to a neutral stance. You will have more activity. So if you are trying to manage your costs, realize that you should get a little bit more activity and work with that kind of backdrop. The worst case scenario would be that we can't get any deals done. inflation picks up, but the U.S. economy doesn't go into a recession. So that actually can keep rates elevated for longer. In any case, you still have majority of people working, but for the mortgage side of it, it's very simple. Rates matter. We're in a better spot now. If there were no tariffs, maybe the Fed talks a little bit more dovish, but the days of Jerome Powell are numbered. And you always want to keep an eye on the labor markets, residential construction worker, jobless claims. Keep an eye on that, because once that breaks, doesn't matter who the Fed president is, rates go lower because bond yields go lower, Fed funds rates go lower, and then you have to re-stimulate the economy. This is why typically you have home sales grow for years after many years of having rates elevated. They don't really just take it right back up to that regard.
Okay. With the remaining time that we have left, I want to quickly focus on the housing economic landscape. So, quick question: how are demographic trends reshaping housing demand and the opportunities available for credit unions or lenders in general?
When we think of housing economics, even with where home prices, taxes, and insurance and rates are, we had near 5 million total home sales, 2023, 2024. We could even surpass that this year. This is existing new home sales put together. That's because the demographics for housing in America are good compared to other countries, right? Of course, millennials are the biggest housing demographic patch ever. Ages 28 to 35 are massive. Gen Z is starting to buy homes actually earlier than what the millennials are. There are actually more Gen Z workers than baby boomers, right? There's near 50 million millennials. There's about 17 million baby boomers. There's a little bit more than 17 million Gen Z. And then my generation, Gen X, we're like the second biggest buyer of homes in the world. And nobody cares about us, which is fine, because we let the millennials and baby boomers fight it out. We'll do great. But when you think about housing demand, you think of baby boomers, silent generation, they're still buying. Gen X, they're the move-up buyers now. Millennials are still the biggest home buyers in America. Whenever rates go up, they lose that title for a little bit, and when rates come down, they get it back. And then Gen Z, you got 5 generation of home buyers right there. And then you have cash buyers, investors. You put it all together, even with elevated prices, taxes, and insurance and everything. Home sales are near 5 million. The last decade, the peak was near 6 million. So you're missing 1 million mortgage buyers. What happens after years and years of depressed sales? Oh, it reminds me of the 1980s. And in the 1980s, housing was more unaffordable. We had 2 recessions in the early 1980s. Everyone said nobody was going to buy a home. Everyone's a renter, and all of a sudden mortgage rates fell 2.5%. Home sales started to pick up. Then it fell another 2.5%. We had a 5% move from 18 to 13%. Home sales started to move, even though affordability was worse back then. So these cycles tend to react the same. It's just not only is our demographics fine in America compared to other countries, the homeowner, right? 70 to 80% of home sellers are buyers. So that seller, one of the reasons why purchase application data is positive year over year, 21 straight weeks. Nobody wants to touch this because nobody knows how to explain it. New listings data is up year over year. That person who's selling their house, majority of them have to fill out an application. Once you get rates lower, demand picks up. This looks like a lot of economic cycles we've had in the past. So it doesn't take much to move the needle, but sales do go up. We're at that last stage where, the Fed is going to stay as restrictive as possible until the labor market breaks, which is my token line since 2022. But it does look better for the future just because of our demographics, and homeowner financial profiles are much better now than they have been ever in history.
Will we see a generational wave once, I forget the generation, but once whatever generation steps out of their parents' basements and starts buying houses?
They've been saying that for the millennials. It's funny, the millennials were the biggest home buyers for like 11 of the last 13 years, but they were saying they're living in their parents' basement. 1/3 of society are lifelong renters. And then human beings were very simple. We rent, we date, we mate, we get married. 3.5 years after marriage, we have kids. We typically buy single family homes. So they are there. The baby boomers were told by the silent generation that they're lifelong renters as well. The silent generations were told they were lifelong. Every generation likes to rip the generation underneath it, right? And they typically end up buying homes. It's the affordability issue that's the problem. But even with everything, I think the easiest way to say it, the NAR would tell you you need $110,000 of income to buy a house with rates this high. Well, dual household incomes is the biggest home buyers in America. One person makes 90, the other makes 70. There's how you get home buyers in America. And that's how you get mortgage demand still slightly positive year over year. So don't worry about the kids. It might take them a little bit longer. They go to school, they get married a little bit later, but they end up buying. And millennials, actually, Gen Z buys houses a little bit earlier than millennials. Millennials had to deal with 2008. But we're good here in America. America has this unbelievable advantage where we have a massive young workforce. Like I always say, Japan, 40% of Japan's population will be dead by the end of the century. They sell more adult diapers than baby diapers over there. Here, Gen Z and millennials combined are bigger than the total population of Japan. Then you have Gen A right behind them. We're okay to keep housing demand at bay for a while. Other countries don't. China doesn't have it. Japan doesn't have it. Europe doesn't have it. Their population growth, prime age is declining, has been for some time. So we got the goods here in America.
Well, we're at time, but before I let you go, any final thoughts?
I'm supposed to say a dad joke, so I've got one. Okay, and the dad joke is, why do watermelons love weddings?
Why?
They can't elope.
That was good. That was good. That was perfect. Thank you very much for that.
Sure. And I can't wait to see all of you in September because the live events are even more energetic and fun than which we do in webinars too.
All right. Well, Logan, thank you very much. And to close out, once again, thank you to Mike and Take 3 Tech for sponsoring today's webinar. And again, to Logan, one for that dad joke, but also his valuable insights. And to all of you, thank you for attending today's webinar. Your time is valuable, and we appreciate you spending the better part of an hour with us. We hope you enjoyed today's session. We understand that 45 minutes isn't nearly enough time to cover everything on this topic, so we want you to learn more and continue to fine-tune your knowledge. I would recommend attending one of our upcoming events or listening to one of our podcasts, where you'll find that we will continue to expand on this topic and much, much more. Head over to www.acuma.org or our community page for more information on the latest updates on everything happening over at ACUMA. Until next time, be well, my friends. Take care. Bye.